subject of today's webinar is FHA 101 with a slant on the benefits to agents and realtors. So we just entitled it Today's FHA Loan. At the end of this short presentation, we'll have time for Q&A. I hope to kind of dispel some of the myths and give you some good information on how FHA loans work, and just give you a little bit of inside information on the guidelines, and then also some benefits and some other things that can help you in listing property or offering on property. So anyway, so basically we're going to introduce, talk about some of the highlights, some of the myths. We'll talk about some of the guidelines, the benefits to buyers, talk a little bit about property. We've got a couple slides on flipping, and we'll get into some of the benefits, and we'll be open for Q&A. We're not trying to make everybody a loan officer and make them understand the whole ins and outs of guidelines, but it's going to give you the broad stroke of how to use FHA in your business so that you can identify someone that's a good candidate for potentially purchasing with an FHA loan, or identify a house that's listed if you're listing a house that may be eligible for FHA financing in a certain way. So let's do a little housekeeping, a little disclosure and licensing about my particular company and branch. A little background on myself. Again, my name is Lauren Winsler, if you haven't heard me before. I'm the branch manager in Santa Rosa of Frost Mortgage, and we're a division of a top 10 private debt-free bank called Primary Residential Mortgage. And I've got a sales and marketing background. I've written books, and used to be a software programmer back in the old days. So that's a little bit about my background, if you cared. So FHA is still exploding. It is a loan program that really was kind of outside of the growth in the early part of the last decade, and people just forgot about FHA because it became too easy to do a lot of other Alt-A or even subprime loans. And but it was common outside of California, and it wasn't used a lot in California primarily because of the loan limits. And the loan limits made a big jump up in 2008. And as all these other loan programs disappeared off the market, it really exploded in popularity in late 2007 and early 2008. And it's now, I think, depending on which statistics you believe, about 35% of the mortgage business, FHA loans, and it's really still exploding. If you read anything about it dying down or moving to the side, that's more on the refinance component of FHA. It's still the number one tool to buy a home in this country. So it's really geared toward first-time home buyers. You've got a buyer or borrower with little or no down payment or money to buy a house. FHA is going to be the first thing they're going to want to look at. And buyers with less than perfect credit. And by the way, if anyone has any trouble hearing me audio-wise, make sure that you click play and check the audio on your audio broadcast. And if you still can't hear me through the audio broadcast or by dialing to the teleconference, put a note in the text chat to the panelists and hosts. So back to the slide, though. I mean, buyers with less than perfect credit, FHA and HUD would not like us to say this, but FHA was really kind of the first Alt-A, less than A paper, less than perfect credit loan. Up until recently, it had no minimum FICO, and you did not technically have to have a credit score, and you could qualify with non-traditional credit. We'll talk a little bit about that. It's a loan that allows new homeowners to buy with, say, their parents or family members, brothers or sisters, to sign and provide income to the loan application as co-signers, or as we call in the loan biz, non-occupant co-borrowers. And some of the hot features about FHA right now, it only requires a 3.5% down payment. So if you buy a $100,000 house, you need $3,500. A $200,000 house, $7,000. that's your minimum down payment to buy the house. It still supports up to 6% seller concessions, okay, where the seller or other interested parties can contribute to the purchase to pay the recurring and non-reoccurring closing costs. The entirety of that 3.5% down may be gift money from a blood relative, family member. Okay, it can't be a gift from anybody, but it has to be a related party. So, so we can source that money, and someone that has no cash in the bank, but mom and dad will step in and provide some of that money. They can buy a house using FHA. It has no reserves requirements. What reserves mean in the loan lingo is, once I buy this house, how much money do I have in the bank before I get my next paycheck? Okay. FHA loans are underwritten and approved solely based on the borrower's income and their job stability and the income they're receiving. So there's no requirement on a traditional FHA loan to have a 1 to 6 months worth of mortgage payment in the bank. Okay. There's no income limits on a normal FHA loan. We've been using FHA loans for low down payment options for people with very good credit and very good income. So it's very important to point that out, that FHA has a stigma as being a low income product, and it is not the case. And for a while, in certain areas where 3 and 5% down PMI disappeared, the FHA product was the only game in town if you didn't put 20% down. So I've used these for doctors, lawyers, investment related folks that are buying up a primary occupancy, with loan amounts over $600,000 now here in California. So very competitive interest rates, and we'll talk about that a little bit more. But the fact that FHA loans are insured by the HUD insurance pool, it actually makes the resulting mortgage-backed securities sold into the secondary market a lower risk. So an FHA loan, a mortgage security backed by FHA loans, is a better investment by many regards because it has an implicit and direct full faith and backing of the U.S. government, like it or not. So these loans, again, to dwell on that point, the government or FHA is not lending the money. It's just insuring it through a self-funded insurance pool. So we make a loan and then send it to get insured. It has a feature called a streamline refinance. It allows a borrower to refinance the note and lower the mortgage payment, or jump from an ARM to a fixed or vice versa, without an appraisal and without requalifying on income. And it has an assumable note, which means that if the borrower or the home buyer passes, to give you an example, the heirs could assume the mortgage and actually assume it in true form, where they become the borrowers either through a streamlined refinance style transaction or by assuming the note. And 30 some years ago, notes were very assumable when interest rates were high. Nowadays, conforming loans do not have that assumability aspect. So the borrowers do have to requalify when they're assuming the note, but it is a unique feature of the FHA loan. It's kind of a nice feature, especially when you've got retired folks buying a home and they're looking at leaving it to their kids, knowing that when that the mortgage isn't going to be a huge headache to work out. So, all right, some highlights of FHA from a purchase perspective. It's limited to owner-occupied only. I still get people looking at this as trying to buy an investment property or condo or something like that. It is limited for the homeowners that are going to live in the property. You can actually buy residential property up to 1 to 4 units. So if you're living in one of the units, you can, if you can qualify an income, buy a property, a duplex, or 3 or 4 unit property. It's rare, but it's possible. It now has a minimum FICO score of 500, so it's still very flexible loan, very flexible underwriting guidelines. Down payment sources can come from a number of different places, including the gift that we talked about before. It's a loan that the underwriters that work for lenders that are direct endorsement full Eagle FHA companies, the underwriter can do a manual underwrite, which means they underwrite the file and the story of the file and why the borrower has certain things on their credit or why their job stability is a certain way. So sometimes things become or get downgraded to manual underwriting. It's actually a benefit. I mean, a lot of loans nowadays without all these automated underwriting systems, it's hard to get loans done if it doesn't go through those systems. So it's good to do, you need good documentation. It's imperative. So the English there doesn't make any sense. Good document is imperative. So we speak English. Anyway, borrowers with an active Chapter 13 bankruptcy, not Chapter 7, but an active workout plan or credit counseling can buy a home. And if they're in credit counseling or Chapter 13, there's a lot more steps to jump through. But just because somebody is working out those things doesn't mean that they can't purchase in the last year or so of that 2-year period. And as far as I know, it's really the only high loan-to-value product for 2 to 4 unit properties. Again, we mentioned the 1 to 4 units, so it may be the case that PMI is allowing that now, but it's attractive. So here's some myths, and if you have a question or a myth or anything, now is a good time to write it down or type it in the chat log. Appraisals are like a home inspection and require the seller to fix everything. And at one time, appraisals with FHA did have a lengthy inspection component and checklist. And we would get all sorts of grief from realtors because the appraiser would say, must fix the cracked window, must fix the torn screen door, and up until 2008, there was an inspection component of the FHA appraisal that would create some headaches. But to dispel that myth, and this, if you walk away with one thing from today's presentation, it might be this, and that is that appraisals are now as is. Okay, there's still a health and safety component. There's still a few things that appraisers will get very concerned about and the underwriter will require the seller to address. But if you're looking at a bank-owned property that's got some damage, minor damage is not going to be a problem to get an FHA loan. Okay, holes in the ceiling where insulation can fall through might be an issue. Holes in the wall where insulation comes out might be an issue. But some missing carpet here or there might not, is not typically going to be an issue where it might have been a problem before. So FHA really wants them to be inhabitable homes. We will talk about property a bit in the coming section here, but sellers are required to pay certain closing costs for the buyer, and there were a few fees here and there that were required to be pushed back on the seller. And in the go-go days, people didn't like that. Realtors hated that. And then back in 2008, FHA stripped those components out, and now the closing costs and the purchase price are really at the mercy of the market, and the negotiation is back in the hands of the buyer and seller to sort out what goes on there. Sellers are required to give a closing cost credit. I had a realtor ask me that one time at an open house, and I scratched my head and I thought about it. Well, it makes sense that they would ask that because as a listing agent, most of the time a first-time home buyer is making an offer with a closing cost credit. I need 3% back. I need $6,000 or $7,000 to cover closing costs. So it's so common, but it's not required. There's nothing in HUD's guidelines that requires a closing cost credit.